I want to teach you a special settings and combination for EMAs. You're going to learn a very accurate trading strategy that tells you exactly when to enter and exit. Just make sure you watch this video until the end and let's get started. Before we start, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, on TradingView platform, here we click on indicators and we search ribbon. We add this one, moving average ribbon, which is a built-in indicator on TradingView platform. And now we need to give some special settings and combination to these moving averages. So here we go to the settings of the indicator, and here in the inputs tab, you can see that we have 4 moving averages. In our trading strategy, we need exponential moving averages. So here for the first moving average, we set it at EMA. Here for the second one, we also set it at EMA. Then we repeat this for the third moving average and we set it at EMA, and for this one we also set it at EMA. For the first moving average we set the length of the moving average at 8. For the second one we also set the length at 8, and then for the first moving average, for the source of calculation we set it at high, and for the second one we set it at low. Then here for the third moving average, we set the length at 34. And for the fourth moving average, we also set the length at 34. For the third moving average, for the source of calculation, we set it at high. And for this one, we set it at low. And then for the first moving average, we set the color to white. For the second one, we also set the color to white. And then for the third moving average, we set the color to yellow. And for this one, we also set the color to yellow. And then we go to the style tab and we increase the thickness of the moving average lines so they will be better visible on our price chart. Alright, we're done with the settings of these moving averages, and now we need to add another 2 moving averages. So here again we click on indicators and we search ribbon, this one. We add this again and we need to change its settings. So here we go to the settings of this ribbon, and here in the inputs tab we remove 2 of the moving averages because we need 2 moving averages here. For the first one it should be EMA, so we set it at EMA. For the second one also EMA, so we set it at EMA. For the first moving average we set the length at 144, and for the second moving average we set the length at 233, and source of calculation for them is close. And then for the first moving average we set the color to blue, and for the second moving average we set the color to green. And finally we go to the style tab and we increase the thickness of the moving average lines so they will be better visible on our price chart. Alright, we're done with the settings of our moving averages, and now let me teach you how you can find accurate buy sell signals based on this trading strategy. But before that, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a complete guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. Alright, getting back to our moving averages, and now let me show how you can trade based on this. These 2 white lines here are EMAs with length of 8, one calculated based on high and the other based on low. And similarly, these 2 yellow lines here are EMAs with length of 34. As you can see, they created a channel, a white channel and a yellow channel. From now we call this white channel and we call this yellow channel. And then we have this blue line, which is an EMA with length of 144, and we have this green line, which is an EMA with length of 233. We use this green line for trend identification, and we use this blue line here for midterm momentum changes and identifying pullbacks, and we use this white channel and yellow channel for identifying buy sell signals. Let me teach you how you can find buy sell signals based on these moving averages. Alright, as I said, this green line here is used for trend identification. When the price goes above the green line, we consider that the market is turning to an uptrend, and when the price goes below the green line, we consider that the market is turning down. Here you can see that the price crossed above the green line and now it is above the green line, so we can consider that the market is turning to an uptrend. In the next step, we want to find a good opportunity to enter a trade. In this case, you can see that the blue line is already above the green line, because this decline of the price was actually a pullback, and the price crossover above the green line actually happened here, and the blue line went above the green line here at this point. Anyway, in this trading strategy, we don't care about this. We want crossing of the price from below the green moving average to above the green moving average. When this crossover happened, we want the blue line also to be above the green line. So in case if it is not already above the green line, we wait to also have the blue line above the green line. In the next step, we want both of the white channel and yellow channel to go completely above the blue line. You can see that it happened here at this point. The yellow channel is above the blue line and the white channel also above the blue line. From now, we wait for a pullback. We want the price to reach the blue line or lower and down to the green line. In case if it goes below the green line, it can be a sign of weakness and the price can go to a trading range, and we can have the price repeatedly going above and below this green line. That is another type of setup that I will explain it later. Make sure you won't miss it, because it is important to also learn that setup because it happens a lot. So here you can see that we got a pullback and the price went down to the green line. When a pullback is happening, the white channel goes inside the yellow channel, and when the market goes flat, we have overlap of these two channels. In this example, we just have a pullback and then bouncing of the price, but in other cases it may become an extended flat market. And as I said, there is an overlap of these two white and yellow channels, and this helps you to clearly see the situation. In the next step, we wait for the white channel to completely go above the yellow channel. You can see that it happened here at this point. When this candle was closed, the white channel is completely above the yellow channel and there is no overlap between them. Before this, there was an overlap of the white channel and the yellow channel. You can see that the overlap started from here up to this point. And as I said, when we have overlap of the white channel and the yellow channel, the market is flat. Could be either a short pullback like what happened here, or it can be an extended flat market, which I show it later in another example. So here, when the white channel is completely goes above the yellow channel, which happened here at this point when this candle was closed, the buy signal is confirmed, and in practice we could enter a long position at this point when this new candle was opened. The stop loss is placed below the pullback or below the green line, whichever that is closer to our entry point. And for the profit target, we set the profit target at 1.5 risk to reward ratio, and you can see that this was a profitable trade. Alright, moving on the chart. After this trade, you can see that again we got another pullback and the price touched the blue line, but after that we didn't get the white channel going above the yellow channel. And you can see again the price went down, and here at this point you can see that the white channel goes completely above the yellow channel. Before this, there was an overlap between them. The overlap started from here up to this point. We had one separation of them here. You can see that the white channel is completely below the yellow channel, but this is a downside separation, and since we are above the green line and blue line, so this is just a noise and we don't pay attention to this. So here, when this candle is closed, the white channel is already above the yellow channel, so the buy signal is confirmed, and in practice we could enter a long position at this point when this new candle was opened. The stop loss below the pullback, which is here at this level, and for the profit target, similarly we set it at 1.5 risk to reward ratio, and this is also a profitable trade, as you can see. After this trade, you can see that again the price went for a pullback, and you can see that the price even reached the green line, and this time we have an extended flat market, but our setup perfectly helps us to enter a trade when the flat market is finished. You can see that from here we have overlap of the two channels, and the white channel couldn't go completely above the yellow channel up to this point, which you can see that the white channel now is completely above the yellow channel. So as you can see, we have overlap of the two channels from here up to this point, and as I mentioned earlier, when we have this situation of overlapping between the two channels, it shows flat market. And when you look at the price action, you can clearly see that the market is moving flat. And in this case, you can see that the white channel and the yellow channel, their overlap here, perfectly guided us on this extended flat market that formed here. So here at this point, when this candle is closed, you can see that the white channel is completely above the yellow channel. So the buy signal is confirmed, and in practice, we could enter a long position at this point with the stop loss below the pullback. Here is a good level for our stop loss, which is the last swing low, or even below the green line. And for the profit target, it should be set at 1.5 risk to reward ratio. Alright, moving on the chart. And now let me show you an example of the other situation where the price goes below the green line. Alright, as you can see, the price still above the green line and the blue line also above the green line. And here you can see that the price went for a pullback, but this time the price went below the green line and we got some candles closed here. When we have this situation, this is a signal that the uptrend is weakening. In this situation, our setup is different. This is a higher risk entry. So if you want only low risk, focus on the type of the setups that I explained earlier. But if you want to take a little more risk, you can also take setups like this. In both of the cases, you need to manage your risk, which I explain it later. Alright, now we have the price below the green line. From now, we wait for having white channel above the yellow channel or below the yellow channel, but the green line and blue line must also confirm that direction. In other words, we are also catching reversal. The price can go up in the direction of the prior trend, the price may go down and a reversal may happen, and we want to also catch that movement. And because of this, we are encountering more risk. Alright, here you can see that the price went up above the green line, above the blue line, again crossed below them and went down below the green line. Here at this point, you can see that the white channel is completely below the yellow channel, but we must have both of the white channel and yellow channel below the green line and blue line, and the blue line must also be below the green line in this case when we are entering a short position. In this case, you can see that it didn't happen. The yellow channel didn't go below the green line and there is overlap between them, so we don't take any action here. Again, you can see that the price went up, crossing above the green line, above the blue line, and here you can see that the white channel went also above the yellow channel, but you can see that the yellow channel still not above the blue line and there is an overlap, so we don't take any action here. Again, the price went down, up, and again went down and up, and here at this point you can see that the white channel completely went above the yellow channel, and from here both of them are above the green line and blue line, and the blue line also is above the green line. Now we have complete separation of them with the order that we want. The white channel above the yellow channel, both of them above the blue line and green line, and the blue line is also above the green line. In this time period, the market was in a trading range, and now the price is out of the range. So in practice, at this point when this candle was closed, which the white channel was completely above the yellow channel, and both of them above the blue line and green line, and the blue line also above the green line, as you can see, the buy signal is confirmed, and in practice we could enter a long position at this point with the stop loss below the green line and profit target at 1.5 risk to reward ratio, and you can see that this was also a profitable trade. Please pay attention that based on price action concepts we could enter a long position here when the range was broken, but based on this trading strategy we have a later entry because of more confirmation. This was an example that after the trading range the price continued the prior trend, but we can also have a reversal. In other words, after the trading range we could get a downside breakout. That's why I said that this setup has higher risk, because here we are not focused on the prior direction anymore and we are trying to catch a break out of the trading range in either direction. But in the first setup, as I showed in the examples, the prior trend matters and we are trying to enter a trade in the pullback within the trend. So this setup has lower risk, but this setup has higher risk. In this particular case, we are entering a trade which is in the direction of the the prior trend. So this is okay, but taking a trade that is against the direction will have higher risk. I recommend you to focus on this setup. I mean taking a trade that is in the direction of the prior trend, so you will have lower amount of risk. But this doesn't mean that your risk is zero. No, there is no trading strategy with guaranteed signals. Losing positions are always part of the game, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's recommended by professional traders. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.